Precious metals, particularly gold and silver, have long held a revered status as stores of value and hedges against inflation and economic uncertainty. In recent years, analysts and investors alike have become increasingly vocal about the concerns of market manipulation, especially in the context of these metals. Michael Oliver, a prominent market analyst, has raised alarms about ongoing price suppression efforts that he attributes to large financial institutions, including central banks like the Federal Reserve. His assertions point to a deliberate strategy aimed at maintaining the stability of fiat currencies by artificially controlling the prices of gold and silver, despite growing demand and economic headwinds. Let's unpack this complex narrative and explore the potential implications for investors. Price manipulation in the precious metals market is not a new phenomenon. It has been a topic of discussion for decades. Analysts like Oliver argue that central banks and financial institutions have a vested interest in keeping gold and silver prices low. The rationale is straightforward. Higher prices for these metals often signal a lack of confidence in fiat currencies, particularly the US dollar, which remains the world's reserve currency. By keeping the prices of gold and silver suppressed, central banks can project an image of economic stability and control over inflation, even if the underlying fundamentals tell a different story. One of the primary tactics employed in this manipulation scheme is the coordinated selling or dumping of large quantities of gold and silver during periods of low trading volume. This strategy is designed to create a sudden drop in prices, triggering stop-loss orders and shaking out smaller investors who may be inclined to hold on to their positions for the long term. The impact of such actions is often seen in the volatility of the precious metals market, where sudden and inexplicable price drops occur despite positive economic indicators that would typically drive prices higher. Michael Oliver has pointed out several instances where large sell orders hit the market during Asian trading hours when liquidity is low. These sales are often executed by major financial institutions with deep ties to central banks, leading many to speculate that there is a coordinated effort to suppress the prices of gold and silver. While direct evidence of such manipulation is difficult to obtain due to the opaque nature of over-the-counter (OTC) markets, patterns of trading activity, and the behavior of institutional players provide strong circumstantial evidence. Despite these alleged manipulation efforts, the underlying demand for gold and silver has shown remarkable resilience. In 2023, gold prices rose by 33%, while silver saw an even more impressive gain of 35%. This surge in prices can be attributed to several key factors, including rising inflation, geopolitical tensions, and increasing awareness among investors about the potential vulnerabilities of fiat currencies. Inflation has been a significant driver of demand for precious metals, as investors seek assets that can preserve purchasing power in an environment where the value of money is steadily eroding. Central banks worldwide have engaged in unprecedented levels of monetary easing, flooding the economy with liquidity in response to economic shocks, such as the COVID-19 pandemic. While these measures were intended to stimulate growth, they have also led to a surge in inflation, diminishing the real returns on traditional assets like bonds and equities. In this context, gold and silver have become attractive alternatives for both retail and institutional investors looking to hedge against inflation. Geopolitical tensions have also played a role in driving demand for precious metals. Events such as the ongoing conflict in Ukraine, rising tensions between the United States and China, and instability in the Middle East have created a climate of uncertainty. Historically, gold and silver have performed well during times of geopolitical turmoil as investors flock to safe haven assets that are perceived to hold their value even in the face of global instability. This trend has been particularly pronounced in 2023, with silver experiencing significant buying pressure from investors concerned about potential disruptions in supply chains and the broader global economy. While gold is primarily viewed as a monetary asset and a store of value, silver has a unique dual role as both a monetary and an industrial commodity. The industrial applications of silver, particularly in the renewable energy sector, have become a significant driver of demand. Silver's conductive properties make it a critical component in the production of solar panels, which are essential for harnessing renewable energy. As the world increasingly shifts toward greener energy solutions, the demand for solar panels, and consequently, silver has surged. The World Silver Survey 2024 highlights this trend, reporting a fifth consecutive year of silver shortages. The deficit reached 142 million ounces in 2023, and projections indicate an even larger shortfall of 265 million ounces by the end of 2024. This sustained deficit underscores the growing gap between supply and demand, driven in large part by industrial applications that show no signs of slowing down. As a result, the price of silver has been under upward pressure, despite the manipulation tactics aimed at keeping it low. The renewable energy sector's demand for silver is only expected to increase as countries implement policies aimed at reducing carbon emissions and transitioning to cleaner energy sources. The Biden administration in the United States, for example, has set ambitious targets for increasing the share of renewable energy in the national grid, a move that is expected to boost the demand for solar panels and, by extension, silver. Similarly, the European Union has unveiled its Green Deal, which aims to make the continent carbon neutral by 2050. These initiatives suggest a long-term structural demand for silver, which could push prices higher regardless of short-term market manipulation. Investor sentiment plays a crucial role in shaping the direction of the precious metals market. Michael Oliver's analysis suggests that there is a growing awareness among both retail and institutional investors about the manipulation of gold and silver prices. As more investors become cognizant of these tactics, they may be more inclined to hold on to their positions, anticipating a future surge in prices once the artificial barriers are removed. This sentiment is particularly strong among those who view precious metals as a hedge against systemic risks and a way to preserve wealth in uncertain times. Oliver predicts that if silver can break through key resistance levels, such as the psychological barrier of $50 per ounce, it could trigger a significant rally. The $50 level has been a historical ceiling for silver, first reached during the Hunt brothers' infamous attempt to corner the market in the 1980s, and again during the 2011 bull market driven by concerns over the European debt crisis. Breaking through this level could attract a new wave of investors, further driving prices higher. He argues that the current situation is akin to a spring-loaded effect, where pent-up demand for silver could lead to a sharp and rapid price surge once manipulation efforts are relaxed or overcome by market forces. The increasing industrial demand for silver, coupled with its role as a safe haven asset, creates a unique dynamic that could see silver outperform gold in the coming years. This divergence between silver's industrial uses and gold's monetary role may become more pronounced, attracting a broader base of investors, seeking exposure to both aspects of the precious metals market. The broader economic environment also plays a significant role in shaping the outlook for gold and silver. In recent years, the global economy has faced a series of unprecedented challenges, from the COVID-19 pandemic and its aftermath to escalating geopolitical conflicts and rising inflation. These factors have eroded confidence in traditional financial systems, leading many investors to seek the stability offered by hard assets like gold and silver. Central banks themselves have become net buyers of gold, a trend that underscores their concerns about the stability of the global financial system. In 2023, central bank purchases of gold reached record levels, with countries like China, Russia, and India leading the charge. These purchases are seen as a move to diversify reserves away from the U.S. dollar and protect against potential devaluation. This trend is likely to continue as geopolitical tensions persist and central banks seek to hedge against their own policies of monetary easing and currency debasement. The political landscape also has significant implications for the precious metals market. The upcoming U.S. presidential election in 2024, for instance, could bring about major policy changes that affect investor sentiment and economic stability. A shift toward more populist or protectionist policies could increase market volatility, driving investors toward safe haven assets. Similarly, continued conflict between major economies, such as the United States and China, could disrupt trade flows and supply chains, exacerbating inflationary pressures and further boosting demand for gold and silver. In summary, the current outlook for gold and silver appears bullish, despite ongoing manipulation efforts aimed at suppressing their prices. The combination of rising inflation, geopolitical instability, and growing industrial demand for silver, particularly in the renewable energy sector, suggests strong upward pressure on prices. Michael Oliver's analysis paints a picture of a market poised for a significant breakout, driven by a spring-loaded effect as pent-up demand is unleashed once artificial price suppression is lifted. Investors who recognize the manipulation tactics at play may see this as an opportunity to accumulate precious metals before a potential surge in prices. As awareness grows, the traditional narratives around gold and silver as mere hedges against inflation may shift to encompass their broader roles in the global economy, particularly in the case of silver's critical industrial applications. While short-term volatility is likely to persist, the long-term fundamentals for gold and silver remain strong. Central bank buying, industrial demand, and a growing recognition of the risks inherent in fiat currencies all point to a future where precious metals play an increasingly important role in preserving wealth and stability. For investors looking to navigate the uncertain waters of the current economic climate, gold and silver offer a compelling case as assets that can weather the storm and potentially provide substantial returns. In conclusion, while the road ahead may be marked by challenges, including continued manipulation and market volatility, the structural factors driving demand for precious metals suggest a bright future. As the economic landscape evolves and investor sentiment shifts, the stage is set for a potential bull market in gold and silver, making them key assets to watch in the years to come.